Where to invest in 2011? Well, our next guest says the same concerns will influence the markets next year as influenced this past one, but there are some new storylines to follow too, and perhaps we've steeled ourselves against some of that risk. We're joined now by Greg Peters, the global head of fixed income at Morgan Stanley. Good morning to you, Greg. Always good having you on the show. Sounds like the dominant risk-on, risk-off trade you see ending.
Well, ending over time. I mean, I still think that's going to drive the markets over the next several months for sure. But I think as the economies start to move along and investors get a better sense that this recovery is somewhat sustainable, then I think you'll see a much normalized process where it's going to be less risk on, risk off, risk on, risk off.
So, I mean, taking a look at where yields are right now, particularly on the 10-year, at what point do equity investors start to get nervous? And where do we start to creep higher there in a way that would perhaps reverse some of the flows into bond funds?
Yeah, I don't think it's a targeted level per se. What I think it's really about the growth and the inflation piece of it. So I think if growth is coming in more strongly than anticipated and yields as a consequence of moving higher, I actually think that's a pretty bullish story for equities. And that's somewhat of our base case. That being said, Margaret, as you mentioned, what we worry about at Morgan Stanley more than anything else is the impact of the rise in yields, since we've seen so much money flow into fixed income at all-time low yields. And I think investors really don't understand the duration risk that they undertake.
So you do see risk in terms of people trying to unwind some of those positions?
Yes, completely. So we've seen a tremendous amount of retail money flow into bond funds. The NAV format basically exposes you to the vagaries of duration. So anytime you see a movement in rates higher, that directly affects your NAV, which is a loss, obviously. And I think that psychological impact has yet to be felt.
So how do you jive that with the broader sort of intention of the Fed right now to keep rates low? I mean, that was supposed to be part of the purpose of QE2, right? So can the Fed keep rates around where they are now through the next year?
You know, it depends how successful they are. It's a really interesting strategy at the end of the day if you're thinking about it, because essentially if the Fed is successful in QE2, then growth is higher, inflation higher, which ultimately means that your bond investment will be less. So it's a tightrope for sure. I mean, we do think yields move higher, not dramatically so, but that is a real question in 2011 for sure.
So did the currency wars worsen in 2011 from your point of view?
Well, you know, I think war is too dramatic of a term, honestly. But
to quote the Brazilian finance minister.
I know. But nonetheless, I do think the rebalancing story, and obviously that's a currency story in 2011, will continue for sure.
Well, you know, in looking at your forecast for the new year, it brings me back to some of the reverberations we're seeing in the market right now with continued concern about Europe. We did just see this morning the Fed continue to keep that dollar lifeline open for central banks. Why do you think that the systemic risk really has been lessened on the euro debt issue?
Well, I think the markets are increasingly just getting used to that noise and that risk. That being said, in order for us to have a decent 2011, and particularly in the first half, what we need to see happen in Europe is a holistic type of solution. If you look at what happened this year, basically Europe has been handling the crisis in an ad hoc basis. I don't think that'll work in 2011. So one of the operating premise that we're working off of for next year is the Europeans actually, quote unquote, attack the issue more holistically to help, you know, reduce the systemic risk.
So no defaults?
You know, it depends how you define default, but I mean, it's an open question.
All right. Thank you very much, Greg.
Right,
always good to talk to you.